Index funds are a great way to speed up the investment process. Anyone new to it may start their road to financial stability by following these simple steps. Index funds is a vital instrument for attaining long-term wealth, depending on your financial goals. Although they frequently have higher fees and higher investment minimums than exchange-traded funds, many investors are drawn to them because of their diversification. It can be challenging to decide which investments are worthwhile because there are so many different sorts competing for your attention. However, if done correctly, investing in index funds may be a quick and simple process. Welcome to Braylen AV. If you haven't yet, please like and subscribe. Number 1. Budget. Before making investing decisions, be sure your budget and life goals are clear. How much time till you want to retire? Before choosing how much to invest, it is important to consider how much cash you can comfortably set aside for investments. Number 2. Financial goals. Your investing choices will rely on the targets you have in mind. Someone who is ready to retire, for instance, will probably have a different asset allocation than someone who has recently graduated from college. As a result, always let your financial goals guide your choices. Number 3. Research mutual funds. You should take some time to investigate various possibilities before you decide to invest in mutual funds. Verify any minimum initial investment requirements, the kinds of operational expenses you'll incur, and any provisions relating to money withdrawals. There are load fees for some. Also, when purchasing or selling mutual funds, an investor must pay a commission known as a load charge. These costs are set by firms and their intermediaries, not all funds charge them. In the long term, fees are a crucial factor to take into account for investors because they lower your returns. Pay close attention to the management fee to see how much you will be paying the fund manager annually. Number 4. Investing strategy. If you want to learn how to invest in index funds, choose an investing strategy and go on from there. Do you seek help from a professional, or do you want to do it yourself, for instance? Your response will determine the type of investment account you need. We have plenty of investing strategies in our blog, braylenav.com. There's information on investing, personal finance, real estate and making money online. Don't forget to visit us, and subscribe to our newsletter. Number 5. Robo-advisor. Decide if you want to utilize a robo-advisor. These services perform the majority of the job for you by investing and rebalancing on their own. Number 6. Create an online brokerage account. Whatever your investment options, there are a few factors to take into account when choosing a brokerage. How simple is the platform to use? Do they also have a mobile app? Any hidden fees? If commission-free trading options are available, you can review the expense ratios. Number 7. Capacity for risk. You can evaluate past performance and establish your risk tolerance before selecting a specific index. For instance, huge cap indexes could be riskier than specialist bonds, which might be less risky. Be aware that there are no guarantees. If you first establish how much you can handle, stay with investing inside your comfort zones. Number 8. Consider both short and long-term costs. Even though index funds from different companies may have similar goals, it's crucial to consider both short and long-term costs. Check any requirements for opening new accounts or making investments in a certain index fund. Expenses, which includes all management fees, and the tax cost ratio, which gauges the amount of taxes you pay based on distributions relative to your returns, are 2 additional key factors to consider when investing in index funds. These costs and related fees can affect your account without you knowing. Typically, a low spending ratio starts at less than 1%. Number 9. Choose an index. A market index represents almost every type of asset. A select number, including the S&P 500, gauge large corporations. Others monitor overseas stocks, such as MSCI emerging markets. A second category of assets that indexes may track are bonds or currencies. If you're just beginning, choosing a broad-based index fund that covers the whole stock market, like the S&P 500, is a great choice. When deciding which index to invest in, take into account industry class. Number 10. Buy mutual fund shares. You typically have two options when you're ready to acquire shares in a mutual fund: buy the shares directly from the fund firm itself, or buy them through your online broker. Setting up a brokerage account is not too difficult if you don't already have one. Before choosing a broker, pay close attention to the quantity of mutual funds offered, and the research tools. Number 11. Keep track of your investments. You may take control of your money by regularly analyzing your investments and making any necessary modifications. Make use of any free tools provided by your broker, such as scheduling a consultation with a financial planner, and always be sure to ask questions. In the end, there is no such thing as a hands-off investment, although few require daily monitoring. Checking up on your assets on a monthly or quarterly basis should be sufficient to ensure that you are on track if you are investing for a goal that is still decades away, such as retirement. Number 12. Manage your portfolio. After choosing the funds you wish to purchase, you should consider how to manage your investment. Rebalancing your portfolio once a year with the intention of maintaining alignment with your diversification strategy is one option. Following through with your strategy will also prevent you from chasing performance. For fund investors and stock pickers who want to invest in a fund after reading how well it performed last year, this is a danger. But it's a cliché in the investment world that previous performance is no guarantee of future performance. Number 13. Set up automatic monthly contributions. You should continue making regular investments as soon as you start investing in index funds. To do this, you might need to set up automatic monthly contributions, or create a schedule for when you add more funds to your portfolio. Number 14. Reevaluate once or twice a year. Although many index funds automatically rebalance, it's a good idea to check that your funds still match your portfolio's goals. Investing in index funds is a great way to diversify your portfolio without taking on too much risk. It is also a way to invest in companies, and have access to a range of markets in different industries. As you begin investing in index funds, keep in mind your short and long-term goals as well as your total costs. Owning them makes sense for a variety of reasons, including diversification, and easy access to a range of financial options. If you found this video helpful, please share it. And visit our description link below. We have more wealth videos for you.